Hi everyone, this is Drew Orton. Along with my colleagues at Nimble Leader, we've put together a multi-part webinar series titled Tactics for Profit Without Leaving Your Office. Our singular focus is to help you drive growth during these challenging times. The segment that begins within the next few seconds will help you increase manufacturing profit now. Hang in there, everyone. Increase manufacturing profit now. This is Drew Orton along with my colleague Scott McBarton. Scott is a managing director with Nimble Leader, also vice president of OnTime Edge, Inc. He aligns manufacturing execution strategies and financial accounting frameworks to drive positive economic value. Scott does this by connecting the dots between systems and root causes of current manufacturing throughput and profit performance. Typically, beginning with 2 production cycles, clients can achieve plus 98% on-time delivery, less order cycle time, less inventory and OpEx, which is pretty darn important, better asset utilization, and generally more throughput. I know everyone's on a tight schedule, so without further delay, let's just jump into the content for our webinar today.
You could start off with relatively meaningful benefit, but you have to really understand kind of the progression. So first of all, you have to realize you have a problem. I think that's why most of you are here today. There's an opportunity within your company to improve, and you'd like to know a little bit about that. Second thing is visualization. Most companies that we work with really want just visibility. What's coming at me, and then how do I deal with that? The next step in the progression would be to synchronize material flow. I mean, for a manufacturer, that's critical. And then from there, we want to optimize. We want to get better at the fundamentals we've put in place, and that just happens on an ongoing basis. And then finally, we're able to capitalize on all the improvement that we've made and then start the cycle over again. So continuous improvement, as it suggests, is an ongoing initiative. And we like to position ourselves as being with you for the duration.
Okay, so these results are really pretty important and very impressive. And Scott, I also agree with the importance of focusing and understanding the value proposition, whether it's price, product superiority, or service. But within the manufacturing environment, you've identified that on-time delivery seems to apply across all companies, regardless of how they are positioned in the market. In your mind, why is this the case? Why is this so important?
Well, I'd say since 1978, when Fred Smith introduced his company to the world, Federal Express, he literally overnight changed delivery expectations. Today, if you're not able to deliver at least on time, then you've got a serious competitive disadvantage. But not only do you have to deliver on time, you have to deliver faster than your competitors. It's just too easy to find other sources of supply of most products. So delivery performance absolutely remains, after 40 years, one of the primary differentiators in the ability to solve your customers' problems.
Okay, so I get it. We live in a want-it-yesterday world. High customer expectations for on-time delivery have been normative for years. And so then why do so many manufacturers struggle to keep their delivery promises? I mean, on-time delivery performance for manufacturers has approximated 80%, and it's been that way for a number of years.
Yeah, it's really interesting to me that remains to be the case. The first issue, though, really is that most companies don't really understand their capacity. They basically will not say no to an order. They're happy to take every order they can take because they never know what's coming around the bend. But as you can see in this particular image, the market demand for this company's products is 60 units per period. But when you look at the physical capacity of that operation, this is an assembly operation, the Forge Work Center, the one you can see there in the middle, only has the ability to produce 50 units per period. So effectively, the opportunity for that company is 50 units per period. So taking orders for 75 or 100 is not necessarily going to improve your ability to serve your customers when you said you would.
Okay, all right. So I understand it logically that this makes sense. You said that was first, and what about the second?
Yeah, the second issue is that most companies today operate with tools that are just inadequate to satisfy this issue. This is an example. Let's take the Forge Work Center again. This is an example of the order profile in that work center. So because modern day ERP systems basically assume unlimited material and capacity availability, this is what happens. You quote a lead time to a customer, you book the order, and let the order flow into the production system. And here's what most people would see, even in constrained work centers. In this particular case, the Forge Work Center has an actual forge capacity of 4 units of production. Yet the orders, if they were going to be delivered when we said they would, have to be produced, would require almost 20 of those units to fulfill those promises.
Okay. All right. So Scott, if achieving high levels of on-time delivery is a consistent and recurring problem, then what's the solution?
Yeah, so first of all, once we understand that we actually do have a capacity issue, either we have capacity that's just is under the demand in the marketplace, which I would refer to as a bottleneck, or we might just have a capacity area that is, relatively stated is a constraint, then we want to make sure that we don't overbook that capacity. So if we were to take a look at that forging operation again, once we've got the ability to actually only commit the capacity that we have, we want to do that on a continuing basis. We don't want to exacerbate the problem by continuing to overbook the performance. So the traditional approach to basically setting up a production schedule was to use a functionality called available to promise, which is essentially a material focused planning tool. But what we really need to do is to simultaneously test material and capacity when quoting a due date. We don't want to use average lead times. We want to use the actual capacity availability to make that commitment. If we can do that, then we actually have a pretty good shot at delivering when we say we will to our customers.
Okay, so that's the capable to promise.
Correct.
Okay, so if manufacturers have limited capacity, then who gets it?
Exactly right. So when most companies started, they knew exactly who they were trying to satisfy in terms of an unmet need in the marketplace. But as time has gone on, and again, this tendency to not want to say no to anybody that's willing to pay you for your product, what happens is we end up filling up our production system with customer orders that are not necessarily aligned with our value proposition. Here's a case that is typical. And I'll tell you what, I've tried to prove Pareto wrong most of my career, but time and time again, I'm faced with the harsh reality. So in this example, this company has 205 customers generating about $11 million in gross profit dollars annually. 20% of their customers actually generate 90% of their gross profit dollars. 13% actually generate about 80% of their gross profit dollars. But what's also interesting here, though, is you look at the other end of the spectrum, 30% or 60 of those customers actually generated net gross profit dollar business. So we have to take a look at both sides of the spectrum. But most companies, especially those of you that are watching today, if you did this exercise, I think you'd see a similar profile.
And when I look at a slide like this, Scott, we talked about this before. This is so powerful. I mean, so you got 60 customers out there with negative gross profit. That's just absolutely amazing. So can we talk about some examples in terms of where you've been able to rectify this?
Yeah, so customer profiling is just a very critical thing that should be done by most companies. Here's a case of a medical device value-added distributor who had 1,200 customers. When they did this analysis, they found that 115 almost just 10% generated 90% of their revenue. So it begged the question, well, why is that? And it turned out that most of the customers that were originally brought on were brought on with the promise by the sales force that they would actually deliver a lot more business across a wider variety of products. But it turned out that 4 or 5 years later, those same customers that were brought on initially were still only buying that one product. So what this customer did was initiated what they called a revenue enhancement opportunity. They decided to experiment. Let's raise the price on the bottom 500 customers. Kind of like in the previous slide, you saw those negative gross margin customers. Let's see what happens. So they raised the price by 100% and did not lose a single customer in the next order cycle. They went to a round 2. Just let's see what happens. Let's raise the price again by 100%. They lost 2 of the 500. I mean, it's a pretty instructive exercise. But in addition to that, lead times were dropped by 80%. On-time delivery performance went up from barely 50% to 100%. Net operating profit increased by 20%. Revenue increased by 20%. Inventories overall dropped 62%. And what was really kind of interesting here was the company had previously approved a $3 million material handling capital investment. at the end of the day, they ultimately emptied their finished goods warehouse because they were delivering more to the demand of the market. And then they were able to also, because of their delivery performance improvement, capture a lead share position in the DoD healthcare system.
Okay, so I'm kind of blown away by the results here, and so if I put my operator's hat on, if inventory goes down by 62%, what that means is that this business is freeing up cash to be able to invest in other things. And the fact that they were able to avoid a $3 million CapEx expenditure is
Yep.
very significant.
Yes.
On top of the other factors you identified here. So really, really pretty impressive.
Yep.
And you had another example as well around mixed management.
Yeah, so that's the other thing too. Here's an industrial wire company, had 16-week lead times, on time and full performance of about 50%, and oscillated their profitability oscillated between barely profitable to barely not profitable for years. An interesting attribute of this particular company's dynamic is that copper was the primary material used in the production of its products, wire and cable, and it was 90% of the sales price. And they could only buy the raw material from two sources of supply. So it wasn't like every other company they competed against was going to get a better price. And at the same time, copper was increasing from its traditional price of about $1 per pound for the last 50 years to over $4 a pound in the course of about 18 months. Now, once they established what their capacity was, they understood how to quote on-time delivery or delivery dates that they could meet. Lead times dropped by 80% from 16 weeks to right around 2 or 3 weeks. On-time delivery performance in the first year went from, again, around 50% to over 90%. They were also able to enter 3 new, more profitable markets and generated the best profitability in their history, and were able to pay bonuses for 8 consecutive quarters. Now, one of the interesting things here about mixed management is that for 3 years, that company bought $50 million worth, 50 million pounds of copper a year. Variability there was about 2%. In the same 3 years, they sold 6 million feet of wire within about 2%. So the only difference was managing the mix, selling products to the people that actually valued their value proposition. And that turned into the most profitable 12 months of their history.
Okay, so Scott, when I look at this, what's powerful for me, again, if I put my operator's hat on, is it's not like there's a whole significant shift in terms of market-based strategy. They were just a little tighter, in terms of those customers that really valued their proposition, and they were able to do this profitable market mix shift. Okay, so these examples are really quite powerful. And Scott, you and I have talked about next steps, for those who are interested, and given current dynamic within the marketplace, we wanted to see if we could provide some value for folks out there without any incremental cash burn. And so, can you share your thoughts on that in terms of where we might go?
Yeah, I mean, the 2 areas of interest that we should pursue immediately, and I'm happy to help. If you could send me a year's worth of sales and gross profit dollars, or whatever metric of value your company views as being critical, and do that by customer, mask the names. I don't need to see the names. All we need to know is that a particular customer did a specific amount of business. What's the average available capacity in terms of the unit of value, right? What's the, at a work center, what is it, pounds poured per employee per month, something like that. I just need to know what's the unit of value. And I need to know it by each work center in the critical routing. You may make 1 million products, but 80% of your business is probably going to go through a pretty common routing. So that's what I would need. It'd be nice to know the on-time delivery performance compared to the initial committed ship date. Again, doesn't even have to be to the customer's required date. What are you telling them you can do, and then how are you doing against that? What's the average quoted lead time, and what's the average material cycle time? Those are the only pieces of information I would need. Optionally, if you provide it, the NAICS code for your business, as precise as you can make it, I'll also augment my report back to you with a peer group financial statement that you can use to kind of gauge your performance relative to your peer group. And I'm certainly happy to spend time on the phone to qualify the data that you're providing, just to make sure that the report back to you is as accurate as it can be.
Okay, so what I hear you saying is you're going to do the analysis, and then with the optional database here from a comparison perspective, we'll be able to do some benchmarking relative to the competitive set.
Absolutely.
And you're willing to do that without any incremental cash burn on the front end. And again, this slide?
Yeah, so again, this is very similar to the one I showed you before, but this is what the deliverable would be. I'll do the customer profiling for you just to get some initial idea of how much opportunity you have to truly identify and focus on the needs of the customers that are driving the greatest amount of value for your firm. And the other thing I would do before I would go fire some of the ones on the right-hand side of this chart is to talk with you about what's interesting about this group of customers. Why are they performing the way they are for you? They might actually be potentially very good customers. So we can have a very healthy conversation about improving the business just from this chart alone.
Okay, so we get an analysis of the business, and then we move on to this. And what is this about controlled material flow?
Okay, so the other thing that we talked about as being critical is understanding capacity. So again, with the data that you would provide, I'd be able to at least do a rough conceptual view of the product flow through your company. Again, this would be the basis of an additional conversation, but you'd probably get a pretty good feel for where the bottleneck or the control point should be in your business and be able to establish a better due date quotation by virtue of understanding your capacity better.
Okay, so we identify where the bottleneck is, and then that carries us back to what you were talking about earlier in terms of the continuous improvement approach.
Right. So in line with the Nimble Leader commitment to provide significant impact without an increase in capital investment, if we follow the progression of improvement that we follow, within 60 days, we'd be able to provide you with enough visibility into what's going on in your business where you could start to take some corrective action. Within 90 days, we could put in place a mechanism to help you synchronize material flow through the operation that understands there is a constraint and that it has to be managed. And then from there, depending on how far you'd like to go, we can move into a more optimized execution of your fulfillment system. And very shortly thereafter that, generally within 6 months for sure, most companies that are committed to this process can get to a point where they can realize the kind of impact that we've been helping companies realize for the last 25 or 30 years.
Okay, so let's say we get to this point without any cash burn, and a company decides that they want to move forward. What's your overall approach to the market?
So, we keep on going generally with the things that we start with because they're essentially fundamental to the opportunity to improve. But we do that in a couple of different billing models. We're very flexible. So time and materials, pay-as-you-go investment. If you feel at any point in time we're not making progress against a plan, then, you can stop paying. But the other options that are kind of nice too are fixed bid and not to exceed models. Again, these are oriented around risk management and trying to make sure that any investment that you're making, you're going to get value out of before you start to feel that that's not happening. But we've never had that situation, so we feel that any one of these would work for you. And the other one that we're always willing to do is gain share programs. The opportunity is so tremendous for most companies to improve. That anybody that would like to engage us in this type of program, we're certainly willing to do. So any kind of model that you can think of, we would be certainly willing to consider.
All right. Okay. So Scott, thanks for your time. This has been a great session. Everyone, if you have any questions, feel free to reach out to Scott or myself. We welcome the opportunity to speak with you. Also, if you've missed our other webinars in the series, we're happy to share our thoughts on these additional segments as well, whether it's reduced costs now, growing your e-commerce revenue, activating all your tools for profit. We also have a session on drive lead generation. And if you and your C-suite team want to do diagnostic relative to your business overall, we have the Shape Diagnostic, and we welcome the opportunity to speak with you on that as well. So everybody, thank you so much for your time. We look forward to hearing from you soon. So everybody take care and have a great day.
Thank you.